What is a bond? When individuals borrow money, they generally borrow it from a bank or finance company. The same's true of small companies, but larger companies, banks and other financial institutions, and sovereign governments are also able to borrow money in the capital markets by issuing bonds. A bond is a security. Think of it as like a certificate that represents the debt of the issuer. Whoever buys the bonds becomes the lender, and the issuer of the bonds owes the money to them and pays interest to them. Investors with capital to put to work may choose to buy the bonds when they're first issued in the primary market or later in the secondary market. Holders of the bonds earn interest that's paid by the issuer. For most bonds, this is in the form of periodic interest payments called coupons, expressed as a percentage of the money originally borrowed. Here is an example of a bond which shows why the interest payments are called coupons. This is a bond issued by Lindsey Materials Company with $100,000 principal amount, meaning it represents $100,000 that was originally lent to the issuer and which will be paid back at the end. When the bond was originally issued, LM Corp borrowed at a rate of 3% for 5 years. And so you see there are 5 annual coupons of $3,000 attached to the bond, and a large piece, the face of amount of $100,000. Originally, before securities trading became an electronic process, bonds were physical instruments, pieces of paper, and on each coupon date, the holder of the bond would cut off the coupon and present it at the issuing and paying agent in return for the interest payment. This is why you may still hear the phrase clipping coupon to describe a bond investment strategy that's focused on earning the interest income.